Good day, my name is Christian Daniels, and today we as Group 109 will be discussing the tax opinion of Amazing Connections regarding the deductibility of the amounts that will be incurred for installation of solar panels. The following costs will be incurred by Amazing Connections, and I will provide a quick summary of the different costs. Amazing Connections will purchase solar panels at an estimated cost of 120 million rand with a useful life of 30 years to provide 18 megawatts of electricity annually. These panels will be ordered and received in 2024, where after 75 million rand will go to installing these panels. The installation process will be completed on 30 September 2024. Furthermore, Amazing Connections will purchase a balance of system for the panels to function for 10 million rand. Amazing Connections will also obtain a permit from the government to install and operate the system at a cost of 750,000 rand. Before the start of the project, Amazing Connections will pay 1.5 million rand for inspection costs and a feasibility analysis. Minor and major maintenance costs of 10,000 rand annually and 500,000 rand every 10 years will be incurred to ensure optimal performance. Amazing Connections will insure the system at an estimated cost of 200,000 rand annually. And lastly, a battery at a cost of 6.45 million rand will be acquired to protect the system from power cuts.
Hi, my name is Tawang Suping and I'll be explaining Section 11A of the Income Tax Act. Firstly, I'll discuss the carrying on of a trade. The following definition of trade is provided in Section 1 of the Income Tax Act. Trade includes every profession, trade, business, employment, calling, occupation, or venture, including the letting of any property and the use or grant of permission to use any patent. Thus, the expenditure is incurred in the carrying on of a trade because Amazing Connection will use the solar panels and the entire system to provide network services when there are power cuts. Expenditure or losses. Expenditure means the spending of funds or the disbursement or consumption of assets. Expenditure requires the movement of assets of the person who expends it. Therefore, we can conclude that all the transactions will be an expenditure once they are incurred, as it will result in the movement of assets, as there could be a decrease in cash or an increase in liabilities. Amazing Connection will spend funds to acquire the solar panels and the system actually incurred. Only expenditure that the taxpayers have actually incurred is deductible. Thus, when the payment is made, does not affect whether expenditure has been incurred or not. Therefore, the expenditure will only be actually incurred once there is an unconditional legal liability for Amazing Connection. During the year of assessment, expenditure is only deductible in the year of assessment it is incurred. The accounting treatment of the expenditure is irrelevant. It will be assumed that the expenditure will be incurred as stated in the required section of the tax opinion for the purposes of the tax opinion. In the production of income, income is defined in Section 1 of the Income Tax Act. Income means the amount remaining of the gross income of any person for any year or period of assessment after deducting thereof any amount exempt from normal tax under Part 1 of Chapter 2. Therefore, income does not include exempt income. The expenditure or loss must be closely connected to the production of income of the business. Since the solar system will allow Amazing Connection to provide network services during power cuts, it will be closely connected to the production of income, not of a capital nature. Expenditure or losses must not be capital in nature. Expenditure can be linked to an income producing operation or income producing structure. Income linked to an income producing operation will not be capital in nature, while income linked to an income producing structure will be capital in nature. Expenditure and losses are capital in nature if it creates an enduring benefit. Therefore, the following transaction relates to an income structure and creates an enduring benefit and thus will be capital in nature. The purchase of the solar panels, the purchase of a balance of system, and the battery power backup.
Good afternoon. My name is Insightful, and I'm going to give you the specific tax treatment of the various transactions below. Under the Section 12 Cap BA of the Income Tax Act, 125% deduction will be allowed on the solar panels and the balance system. For the solar panels, a total deduction of 243,750,000 will be allowed on the total cost of the purchase price and the installation cost, as these will be direct costs to the solar panels. Therefore, for the balance system, on the total cost of 10 million, 12.5 million will be allowed as a deduction once off. The new employees will be employed or create an expenditure which will be under the carrying of trade. Therefore, a Section 11A deduction will be allowed of 1.8 million annually. Cost of obtaining a permit are not in the production of income of amazing connections, therefore no deduction will be allowed for these costs. Inspection costs and feasibility analysis, on the other hand, will meet the Section 11A requirements of clearing of trade, and therefore a full deduction will be allowed in the year of assessment incurred. Maintenance costs, on the other hand, both the minor and the major costs will be allowed a full deduction in the year of assessment incurred, but if these costs constitute improvement costs, which will be of a capital nature, there will be no deduction allowed.
Good day, my name is Nicole Whiteley. The insurance cost meets the Section 11A definition of general deductions in the Income Tax Act. A deduction shall be allowed every year in which the expense is incurred. This will be for the 20 years that the project will be over. 2024 to 2043 will have a R200,000 deduction each year. Section 11E of General Deductions Allowed in the Income Tax Act will be applicable to the battery power backup. BGRN 7 of the Income Tax Act states that battery chargers are allowed a 5-year write-off period. As the battery power backup will be bought on the 30th of September 2024, the current year of assessment's wear and tear allowance must be apportioned by how many months it will be in use, thus 5 of 12 months. The following deduction will be allowed. For 2024, R322,500. For 2025, R1,290,000. For 2026, R1,290,000. For 2027, R1,290,000. For 2028, R1,290,000. And finally, for 2029, R967,500. The amounts proven above as deductible will be deductible in the prospective years stated. Any tax advice herein is based on the facts provided to us as at May 2024 and on current tax law, including judicial and administrative interpretation. Tax law is subject to continual changes and at times on a retrospective basis. It may result in incremental taxes, interest, or penalties. Should the facts provided to us be incorrect or incomplete, or should the law or its interpretations change, advice may be inappropriate or not applicable. We are not responsible for updating our advice for changes in law or interpretation after the date hereof, May 2024.